to sort of introduce what it is to be the Chief Investment Officer at BlackRock over ETFs and index funds at this moment in time.
Sure, and thank you so much for having me. I am a native New Yorker, so it's also particularly exciting for me to kind of see that New York City is such a big part of Chainalysis links. I am older than the mayor's chief technology officer. I think my first video game was like Frogger or something like that. I've seen a lot of market environments, and I am, to be clear, a markets and investments person. And so, as these are strange economic times. I've seen a lot of strange economic times over the course of my career, and one thing I hope will come out of this next 15 minutes or so is the importance of some of the learnings around volatile markets and volatile market safeguards that have really been born of kind of, decades, not just my decades, but before me, of markets innovation. So as you said, I'm the Chief Investment Officer of BlackRock's ETF and index business. BlackRock is an investment manager. We manage investment portfolios for investors. Our purpose is to help more and more people experience financial well-being. And about half of our assets are in ETF and index products. So my job is to deliver investment performance, which really means two things. It means, number one, delivering the index outcome that the investor expects, whether it's a U.S. domestic equity outcome or a fixed income outcome or something in commodities or multi-assets. And the second piece of it is what we call ETF market quality. It's ensuring that ETFs trade in the market with like the highest levels of liquidity, market quality, access, and transparency. So that's my job at BlackRock.
And we think about crypto as an investment class as a disruptive technology. When we think about ETFs and indices and index funds, that was also actually a disruptive technology. And so in these sort of financial revolutions, maybe talk a little bit about sort of lessons learned about that as a disruptive technology in the investment world.
Sure, and it is one of the reasons I'm excited that you invited me to speak, because I do think of ETFs as as something that was a very positive, disruptive and positive development for markets. And look, I am a markets history nerd. I can talk about millennia of development in market innovation and what has helped investors, to this day, engage more, have broader access and more transparency, which is really the common theme in how markets have evolved. And what ETFs did, it's actually a two-part story. It's an indexation and ETF story. And interesting, there is a very important technology component of the indexation piece, because until technology could support the actual, visibility and management of a large basket of securities, indexation as an investment strategy wasn't really accessible. The first index investment product happened in 1971, which was actually the year the first commercial microchip was produced. And ETFs as a story happened actually 20 years later, so 30 years ago, where we were able to take the index portfolio and put it on a stock exchange. So the actual index portfolio was visible intraday, trading on an exchange with exchange liquidity, and brought that much more, again, access, visibility, and transparency. And of course, we know that there is a virtuous cycle with transparency, investor confidence, and commitment to the technology, which in this case was the ETF. And I should add, since you brought up the market environment, even in the 7 years that I've been at BlackRock in this role, when I started, I think ETFs were probably on a daily basis in the United States about 22% of everything that traded on a daily basis in the US equity market. We hit a high a week ago today of 45%. And something that we have seen again and again, particularly through the COVID volatility period, is when markets are volatile, investors turn to whatever is most accessible and most transparent. And in US equity markets, it's become the ETFs. So they're a really important tool in volatile markets.
And I think that there's, you talk about the dependence on technology to actually produce these new products for consumers. And I think that, there's a lot of, promise around crypto that, Jakob talked about smart contract composability that you can build on top of other things. And you look at the broader sort of crypto market and you can see just, tons of potential for innovative financial products. What are some of the lessons that crypto needs to learn from innovations around, ETFs and, building inclusive financial products for consumers?
So I think, very top of mind right now is certainly the importance of sound operating models and guardrails in volatile markets. So both of those things are critically important. And I think, that's, Michael mentioned in his comments, what happened specific to UST last week. But I think it's kind of a good example in terms of looking at, UST and the world of stable coins, like what are investors' expectations in terms of their redemption? Where does it work? Where does it not work? What are the learnings from that? And certainly also guardrails in volatile markets, because one of the things that's such a benefit, I think, to crypto is market access and 24/7 access and continuous trading. But in volatile markets, things can happen very quickly, and guardrails can have a very big impact. And there is loads of learnings across TradFi capital markets around circuit breakers, volatility halts, limit states, things like that I think are potentially applicable, particularly to trading.
Yeah, and when you, obviously you spend most of your time looking at traditional markets, and when you first saw sort of applications tick in on a Bitcoin ETF to the SEC, what was sort of your reaction to that? Did that make sense? And yeah, what was your initial reaction?
Sure. Well, I guess to your point, when I first learned about crypto, it was actually, prior to my being in an ETF and index seat. But I think where my head really was around the impact of permissioned blockchains in particular to lots of parts of financial services. My kind of prior world was in the derivatives market, so lots of areas where there was definitely a need for reduced friction, counterparty trust, more transparency. So I think, at the time, again, very much kind of supportive of work that was unfolding across the industry around permissioned blockchains. And when, talk started happening around crypto ETFs, and this was even prior to applications being submitted to the SEC, I was actually pretty surprised, because one of the things that makes me so excited about the ETF is the fact that it provides access to, hard to access, expensive to access, or even inaccessible markets. And, crypto is like pretty transparent and accessible. That's the promise of crypto. It doesn't take too long to, I timed myself once, and I think it took me like less than 2 minutes to set up an app on my phone, link my bank account, and trade something. And so that was my first reaction, like what is the incremental value the ETF wrapper offers to crypto? And I think subsequent to that, one of the things I've learned that I hope is also a theme and a takeaway from this conversation is the real importance to investors of interoperability. Like it's an easy thing for a personal investor to set up something and access a new asset class, but actually for institutional investors to kind of adopt and due diligence on a whole new market structure is quite difficult. So the ETP wrapper, and we would call it actually an ETP, exchange traded product, versus ETF, because it's not actually a fund in this case. But that wrapper does have the benefit of providing these kind of legacy, well-traveled on-ramps and off-ramps. So But that's kind of what my journey has been around it. And I should add, though, since you mentioned the SEC applications in particular, again, the importance of investors understanding what they're buying. Because in the case of the US, many of you may know this, spot crypto ETPs or exchange-traded commodities, ETCs, aren't available in the US. So what is available are futures-based Bitcoin ETFs. And from our perspective then, an investor who is looking to get spot Bitcoin exposure needs to understand that given the regulatory position limits for Bitcoin futures, they won't get that exposure in a futures-based ETF. So from our perspective, it wouldn't be, it wouldn't meet what I think investors are looking for in a Bitcoin ETF.
And it's interesting that because we're at a point where we're trying to have this conversation about maturation and providing easier access, and also providing the right product for the right person that matches their expectations. When you think about sort of, BlackRock is very much about empowering people and making sure that they can get their financial health and well-being, and actually broadening access, like the ETF broadened access very much in this country. What are the opportunities that crypto does present for BlackRock's business?
So look, I think that there are four. We've talked about, native crypto. We've talked about permissioned blockchains. I think that tokenization might be the kind of longer term opportunity, but I think that's a really exciting one. Making asset classes accessible that have been previously inaccessible, that's a real possibility, I think, with tokenization. And the fourth we did talk about a little bit as well. I think that is stable coins. And I think that's quite interesting because, again, from an adopting investor's perspective, the stablecoin kind of removes some of the unknown price volatility of the kind of digital native currency, but allows for an on-ramp and participation in the digital ecosystem, which actually can have potentially very big benefits, particularly around payments.
Yeah, and we've seen, we saw that you announced a partnership with Circle, an investment there, and then obviously the backdrop of UST sort of collapsing last week. How do you differentiate? I mean, clearly, you chose to sort of invest in Circle and back that. How do you think about the different forms of stablecoin, and how do recent events sort of impact your thinking on this space?
Well, importantly, I think the importance is to differentiate. As you said, there are different types of operating models, and for us, really, the past several years have been around, engaging as thoughtfully, and as well as thoughtfully as we can with really great partners, like you, for example. And also like Circle. And so kind of understanding the differences between an algorithmic stablecoin, a collateralized, centralized stablecoin, which is what USDC is, and the relative performance of those two in a very volatile market. I think that's very instructive for the market, for investors. But one thing I do want to point out, and this is something I have lived with in the ETF world, and my colleagues sometimes laugh at me that I get so strict around what I will allow everybody to call an ETF, and we're very much public on the record saying there should be a better labeling system. I would kind of propose the same thing for stable coins and for digital currencies, because as much as I agree with Michael's point that what happened last week was quite isolated to Terra and to Luna, the fact is it does have an impact from a trust, confidence, and reputational perspective. So again, labeling, transparency, industry standards so that investors understand this very profound difference in operating models, I think is another, TradFi learning.
No, we love the TradFi learnings. But thinking about less TradFi and maybe into the future of TradFi, the space moves so quickly. You've had different different strategies and engagement with the space over the last, as you said, like 7-8 years as a firm. How do you think into the future about BlackRock's involvement in the industry?
Well, as much as it feels like the space is moving quickly, as I said earlier, markets evolve over millennia. So I think the important point I want to make is, TradFi is not going away. And so I think for, all of you here, for us in our partnership and conversations, thinking about and planning for the interoperability of the ecosystems is critically important and will surely shape any path of adoption that happens over the next couple of years. I actually thought it was super interesting hearing all three of the speakers earlier who referenced, I'm going to get this wrong, but multi-chain interaction, because as important as that is, it presumes a crypto-only ecosystem. And I think from an investor's perspective, what really matters is the interoperability of the crypto and the TradFi ecosystems, because that will not only be a reality for the foreseeable future. I think how well those on-ramps and off-ramps work will actually inform crypto adoption and confidence.
Yeah, and I think to your point, we start to see sort of the incarnation of TradFi assets like stablecoins being sort of that bridge, if you will, between sort of traditional finance and the crypto industry, and so seeing real brand names look at ways to support that and think through what those standards should look like, how to better position the expectations that markets can place on those types of assets will change sort of the landscape of both TradFi and also the crypto industry. So we're very excited to have those definitions and to really make sure that there's concrete expectations being set into the market. Many people who are maybe less familiar with BlackRock maybe don't know that there's a very large technology business that is also part of BlackRock, and maybe explain a little bit about how that functions and how that makes BlackRock different. But is there a world in which this is also a technology play for BlackRock long term?
Absolutely. I think it's probably a technology first play for BlackRock. And look, actually, I said that I've been at BlackRock the past 7 years, but I've had basically 2 jobs. BlackRock was the first place I went to work after college. Then I went to business school, worked at an investment bank, so I was gone for 18 years, and then I came back to BlackRock. When I first started at BlackRock, it was shortly after BlackRock's founding, and I think this is important because as much as BlackRock was founded as an asset management firm, technology and best-in-class risk management tools were very much the DNA and the founding purpose of BlackRock, which was a bond expertise shop basically at inception, with the desire to, at this time, the fixed income market was quite volatile, maturing rapidly. Mortgage-backed securities, different types of mortgage-backed securitizations were increasingly being adopted, and BlackRock's founders really wanted to bring best-in-class risk management and asset management expertise directly to investors. So that was really the founding mission. So Aladdin, our technology business, wasn't something new that was started later. It was like the bedrock of portfolio managers and risk managers at BlackRock. And then, the firm made the decision to provide Aladdin as risk management infrastructure for other asset managers, who managed assets on behalf of others. So just to frame it, that's the as I said, that's the DNA of our firm. So I think engaging thoughtfully with new and innovative technologies, not necessarily being first to market, but being best in class when we get there to provide better management of risk and financial outcomes for our clients. That's why we come to work every day.
Well, it's super exciting to have BlackRock participating in the industry and sort of leading conversations around how institutional adoption, how consumer adoption should really happen in this market. And you've obviously done a huge amount for financial inclusion and financial well-being in the country already. We're excited to see what happens in the crypto market. Thanks so much for joining me here today, and we'll take these lessons into the rest of the conversation.
Thanks for having me.